We also have economic data that we got to talk about, right? The Fed's preferred inflation metric showing prices continuing to ease in September. Year-over-year core PCE coming in at 3.7%. That's the smallest gain year-over-year since 2021. It comes after the U.S. economy grew at its fastest pace in nearly 2 years. As the Federal Reserve gears up for its next meeting, we're taking a look at what this all means for future rate policy. And joining us now, Rowe Price Chief U.S. Economist Blerina Uruci. Thanks so much for being here, because even the signals today, even the PCE today, Blerina, I could argue you could look at it in a number of different ways in terms of your slicing and dicing, because month over month we saw reacceleration, but year over year the numbers look better. What's your takeaway for what this is going to mean for the Fed?
Thank you for having me today. And we have a complex economics picture here. A few unexpected things have happened during this business cycle. We're having progress on inflation, moving down from the peak of 2022. At the same time, the unemployment rate is at historical lows and consumer spending remains strong. So I think as we go forward, a couple of things that are going to be the focus for the Fed. I think they're going to maintain a hawkish bias because the economy is so resilient and the progress that we've had on inflation has not really spread over to services inflation that is more tightly linked to the labor market. So that's one part of it. But the way that this hawkishness is going to express itself, now that interest rates are at about 5.5%, is through pushing back against market pricing of cuts in 2024. So currently the market is pricing that cuts from the Fed will start in the middle of next year. I think this is too soon, and Fed communication will probably push back against that. But more importantly, as the economy remains resilient, I think market probabilities for next year will push those cuts further back too. But there is also an aspect that we need to discuss and recognize is the fact that the long end of the yield curve has increased a lot. Yields are up significantly since the last Fed meeting in September. And so I think what this means for the Fed is that perhaps they don't need to deliver as many hikes, for this year as they had promised at the September meeting.
And Blerina, when you look at that labor market right now and how it's sturdy, so sub 4% unemployment, wages rising, can the Fed get inflation back to its target, back to 2% with a labor market that is that sturdy?
So this is the key question for the Fed. So just quickly, when I characterize the labor market with our PMs in our discussions, what I see is a cooling in the labor market through slower employment growth and higher vacancies, but not a rolling over. So then the question is, can we bring inflation down to 2% without a meaningful increase in the unemployment rate and more significant layoffs in the economy? Historically, the U.S. economy has not been able to do this. What could be different this time around is that we're seeing an improvement in labor supply. The labor force participation is increasing, and this could be bringing downward pressure on wages. In fact, quits rates are not as elevated as they had been for the last 2 years. They're now back to pre-pandemic levels. And the key will be perhaps that the Fed learns the lessons of the past. It proceeds cautiously now, but it does not cut interest rates prematurely. So then if you keep the pressure on inflation and the economy throughout 2024, we might have a chance of avoiding a deep recession while also bringing inflation down.
It seems like it's still going to be a tough needle to thread potentially. And I'm fascinated by a chart that we got from Apollo's Torsten Slok today, where he basically posits that the market always gets wrong when the Fed is going to raise or cut, that it sort of always overestimates how soon these things are going to happen as priced in by Fed funds futures. And so this time around, how do we and there's a chart showing that basically Fed funds futures in blue, all the times that the expectations were so wildly different than from what actually happened. So what does that then tell us about how cautious the Fed might be and the implications for the economy?
So when I look at that chart, the first impression that I have is that forecasting is really difficult, be that
Yes.
economist or market pricing. We get it wrong all the time. And so let's be humble about it and let's admit, where do we have more visibility? Right now, we look at economic data. The US consumer is very resilient. Their balance sheets are strong. Employment growth is solid. So that means to me, no imminent recession risks. So at least I have more confidence 6 months out that the US economy is not going to slide into a recession. And so that should translate into a Fed that does not cut interest rates as fast as the market is expected right now, because there's not going to be the need to.
And Blerina, last question here on the consumer. A couple different data points. I want to bounce them off you and see what you make of it, because we got consumer spending numbers today too, and this rose 0.7% in September. I think it was 0.4% when inflation adjusted. So that would signal we do keep spending here, our friends and our neighbors. There was also, though, Blerina, it was interesting, Amazon's CFO on their earnings call. He said from a customer behavior standpoint, we still see customers remaining cautious about price, trading down where they can, and seeking out deals, coupled with lower spending on discretionary items. I thought those were just interesting data points. Bottom line, Blerina, when you look at the consumer right now, how strong and healthy are they right now, and what do you see ahead?
So I think the US consumer, being 70% of the US economy, is really the key to sustained growth and a sustained recovery. And ultimately, what matters for the US consumer is the labor market and whether we're seeing continued increases in employment. So employment growth is strong, and that helps to deliver solid aggregate income growth. And that's what's supporting consumption right now. The other thing is inflation is coming down. So real disposable income has also improved in recent months. That's another positive for the consumer. And then if you wanted to take a longer structural view of the consumer, you'd look at their balance sheets. Asset as a share of liabilities are at historic highs. Debt servicing costs are relatively low, even though interest rates have increased so much, because a lot of the household debt is locked in at lower interest rates. And so this business cycle, we don't have the kind of deleveraging that the consumer was doing post GFC. They have more firing power. Also, they have more ability to leverage to fund consumption. And I think this is what is prolonging the life of this recovery, even though interest rates have been increasing so fast. I think this is where people are maybe going wrong when they expect the US consumer to roll over quickly.
Blerina Uruci, thank you so much for joining us today.